Hello everybody, thank you for joining us today. I'm Alison Horner, I'm Head of Indirect Tax at MHA McIntyre Hudson. Before I introduce our speakers, a little housekeeping. We've very kindly received quite a few questions from you and we will deal with these at the end. If you've got any questions that you'd like to ask during the webinar, then please do enter it into the chat button and we will try and pick these up at the end, and if we're not able to because of time, we will come back to you with an answer separately. Also, we're going to run a few questions for you as we go through the webinar. So a poll will come up, we'll put the questions up, and then you'll be able to select an answer. And it'd be great if you would participate. So thank you very much. So let me introduce you to our speakers and my esteemed colleagues. I think he's got to stop sharing the screen. We're just going to get everybody up so you can see them. There they all are. Thank you. So first of all, in the actual room with me and not in Zoom is Andrew Thurston. He's our customs duty specialist. He has many years experience in customs duty, and with the spotlight firmly on customs duty at the moment, he's very much the guy that you want by your side to get through this maze of customs duty. Now, over the water to the Netherlands, and let me introduce Marisa from Baker Tilly, Netherlands to you. We work with Marisa on a daily basis at the moment, and if your business is considering using the Netherlands as a hub for its European distribution post-Brexit, then she's going to provide the reassuring support that you're going to need through that process. And Marisa's going to talk to us about the practicalities of doing business in Europe post-Brexit, and all the VAT issues that go with it. Now, on to the big strategic decisions that your business may be considering and discussing at the moment. And that will be around whether or not to have a permanent establishment in Europe and all the complex people issues that go with it. And to deal with this, we have Chris Daines, who is an international tax partner. And Chris also heads up our global tax solution offering across the Baker Tilly network. So he really is a global Mr. Fix-It. And Richard heads up our global mobility offering for MHA McIntyre Hudson. And, you know, people are so key to all of our businesses, and the complex issues that go with that and sorting that out will be very much at the forefront of everybody's mind as we move to Brexit. So that's everybody. Let's get on to the conversation. So we are at the 3rd of September and we are back to school, back to work and back to Brexit. Don't know about you, but today feels very much like we are really back in it and everybody wants to crack on with things. So where are we at the moment? Well, the UK is in the transitional period until the 31st of December this year. And until then, we trade VAT and duty free with no changes, which is great. But the risk of a no deal is high. And as we've all seen in the press, there's a lot of press around the negotiations. Are they going? Are they stalling? We're stuck on fisheries. Now, to have a deal in place, it's not the end of the year we're looking at. It needs to be resolved by mid-October when the European Council meets in order to ratify it by the end of October to make it into law. So that's obviously the big question at the moment that the powers that be are dealing with. So from the 1st of January 2021, when Brexit comes into being, and if we have a no deal, and even if we have a deal, all goods from the European Union into the UK will become imports into the UK, and that means customs duty declarations and customs duty to deal with. And the same applies for goods which are sent from the UK as exports into the EU. They will become imports into the European Union. So we've got challenges ahead, and let's first of all look, as the spotlight is on customs duty, at the customs duty changes that have been announced by the UK government. So, Andrew, tell us all about the UK global tariff, please.
Okay, well, the global tariff was released by the UK government in May. And there are a number of changes to what is in place at the moment. That's the current EU tariff. So one of the important things was the simplification of the bandings. So rather than it be something like 3.5%, they dropped it down to 2%. So generally, all the duty rates that will apply from the 1st of January will be lower than what are currently in place for non-EU movements. They've also scrapped the tariffs below 2% because they're classed as nuisance tariffs. It wasn't worth the administration to maintain those tariffs. They've also liberalised a number of commodity codes. I think it's nearly 2,000 in all. And what that is it's designed to assist manufacturers. So the commodity codes relate to goods that are going to be processed in the UK, so that they're not incurring any customs duties. So they're all being reduced to 0%. So that will hopefully be of great benefit to a number of companies who are involved in manufacturing in the UK. So that's the global tariff.
Okay. I mean, we've got one of the questions we were asked is, what is the highest duty tariff rate that will come into the UK? Could you give us an idea of, something that's low, something that's in the middle, and something that's high?
One of the higher tariffs, which is intended to drop, is the commercial vehicles. I think it's 20% at the moment. It's going to drop down to 10% to be in line with all the other motor vehicles. So it shows the level of duty that is in place in some instances, and obviously depends on what the goods are. Mm-hmm. Some are based upon an ad valorem duty rate, which is a percentage. Others are all based upon a specific duty rate, which is based upon it would be pounds per 100 kilograms. So certain foodstuffs apply duty based upon their net mass rather than the value, and they can be quite considerable. There's also anti-dumping duties that are currently in place that have been set by the EU. The UK are intending to carry on, I think, about 43 of those. Mm-hmm. So there will still be potential for anti-dumping duties, and they will be looked at over the course of the next 12 to 18 months to make sure that they are still relevant, and there will be a new team set up by the government which is going to control that side of things.
Thank you. And I think it's worth pointing out, isn't it, that if we have no deal for any goods that we as UK businesses import into Europe, it will be the WTO tariffs, mm-hmm. which, if you are looking for what that might be for your business, they're easy to identify on the Europa website mm-hmm. or on HMRC's website to get a feel for that. Moving on, there was another simplification measure announced to do with deferred import declarations, although I'm not sure we were quite convinced about whether or not it's a real simplification for businesses.
Yeah, it's because of COVID, the government decided to put this measure in place, partly for importers, but partly for the freight industry, who were obviously unable to train staff to meet the demands of Brexit during the last sort of 6 months. So it basically allows UK importers to delay making customs declaration for up to 6 months. So between the 1st of January and the 30th of June, they can delay import declarations for 6 months for most goods. If it's excise goods and prohibited and restricted goods, then they have to be from day one declared as normal. So it's a system that you obviously need to have your records in place. You have to have an agent that is capable of making a declaration through what we call the CFSP system. Otherwise, you're going to have to use the normal import declaration process.
So it seems to us that because you need to have the paperwork and the figures available, it might be a little bit of a false hope to think, well, I don't need to worry about customs declarations for 6 months because I can do it all then. Because I think that then leads on to our next point, which is there's been a big change to import VAT, and there is going to be postponed import VAT accounting, which is used in a number of countries throughout Europe at the moment anyway, and I think the UK used it many, many years back. So that's going to be a good cash flow benefit for everybody importing, because at the moment you have to pay your import VAT on clearance of the goods up front to get your goods into the country, and then you claim it back, say 3 months later, on your VAT return. So instead, postponed import VAT accounting will be you account for it on your VAT return, so pretty much like you would do in an intra-EU trade at the moment. So that's a good cash flow benefit for everybody, but it sort of dovetails back into that deferred import declaration, which is, well, if you're not going to declare everything for 6 months, how can you possibly do?
If you're doing postponed VAT accounting with delayed imports, you've got to estimate the amount of VAT that you that's applied to that import, and then put it through your VAT return, and potentially have to amend it on your following VAT return once you've established what the correct VAT amount is. So there's additional admin involved in monitoring that and making sure the VAT element is correct. But if you're just doing a normal, straightforward import from day one, the VAT element is calculated and it just goes through without being paid, and then appears on a separate report, so you can then put it through your VAT records.
So I think the point to get here is that there's the simplification for deferred import declarations, but with postponed import VAT accounting, first of all, you don't need to use postponed import VAT accounting. Well, actually you do. You need to use it if you're using the deferred import declarations. So what you probably need to be aware of is that you can still use a customs agent, you can still import as normal. Do not be blinded by, I don't need to worry about import declarations for 6 months, because you're still going to need to deal with customs agents and deal with getting the import VAT dealt with. Just a quick message, just a quick shout out for the low value imports rule, which is going to change from the 1st of January. And that's effectively, if you are selling to consumers under that £135 limit, as an overseas trader, you're going to have to be registered for that or sell through an online marketplace in the UK. So that's going to have a significant impact. And that was one of the changes mentioned. And then finally, on this particular slide, Northern Ireland Protocol has been announced. And I think it's been announced by the government, and they say, we will come back to you with the detail, because it just is something that you look at and think, how is that going to work? And I think, could you mention about the customs declarations possibility?
Yes, obviously the UK is split in terms of the Northern Ireland Protocol, so it becomes Northern Ireland and GB basically. So if you're exporting from GB or mainland UK into Northern Ireland, you will have to make some form of customs declaration. What the government have announced is that they're going to develop a new system called TSS, which is going to be free to use, supposed to be as simple as possible, so that companies can export goods into Northern Ireland without any added bureaucracy. There will be additional checks at the border for certain animal produce and flowers and things like that that need phytosanitary certificates, but they're trying to minimise that as much as possible. But this is part of an ongoing discussion with the EU in a separate committee to the Brexit talks, to sort of flesh these things out. So it's not been confirmed as yet what's going to happen, so that's why it's a bit vague, but it's a sort of watch this space really and see what happens. It's a watch this space with a hell of a lot of complexity and possibly some real opportunities for Northern Ireland. There seems to be a bit of an open border going on there, and there is the suggestion that if you're based in Northern Ireland, you will have an EU VAT number and a UK VAT number, just to have a bit of extra fun added into things. So let's shoot on to the next slide that we've got, which is to deal with the key points, the things that we think are the things that you really need to be looking out for as we head towards Brexit. At top of this list, and Marisa will laugh at this, is because it's Incoterms, and we're forever on conference calls talking about DDP. Watch out for DDP. Make sure you know if you are selling DDP, which means delivered duty paid, isn't it? Yeah. Could you maybe tell everybody a little bit about why these things are so important and why people are going to need to get to grips with it? Basically, the Incoterms determine at what point your responsibilities in the transport of that load hit. So with DDP, the big risk is that if you've agreed to deliver those goods to an agreed point, you are also liable to be paying the customs duties and potentially import VAT into the EU, which means you need to be VAT registered, have an EORI, those extra responsibilities. So that's, at the moment, trading with the EU is probably not something that's considered too much because you agree to deliver those goods to that customer. But once we leave the EU, there's the customs implications of it and who's going to be liable for the customs duties. Because if it's the UK company exporting to the EU, it's a cost that they potentially are going to have to absorb into their existing cost price, certainly for the short term until contracts can be negotiated.
It really is of the absolute utmost importance that everybody understands whether they're going to be tied into DDP terms. And Marisa will pick up on this, but it will mean VAT registration in many jurisdictions if you are selling DDP into the European Union, and likewise for European businesses that are delivering and selling delivered to the door to the buyer in the UK. That will also mean a UK VAT registration issue. And I think it's quite clear to everybody, because we now have a big border in the middle of from the UK to Europe, that customs duty is happening, and you could end up with a double duty hit in many instances, which leads us on to the next point to deal with customs procedures and how we can maybe minimise duty costs.
Yes, obviously a lot of companies trade between the UK and the EU and then sell their goods backwards. So it's backwards and forwards movement. They'll purchase a part, process it, send the finished product back out into the EU market. So there are a lot of customs regimes that HMRC currently have available, and they're the same. They won't change too much once we leave the EU. So there's things like customs warehousing, where a company can import goods without paying the duty and VAT. They can store them for a limited time, and then if they export them out of the UK, then that discharges the duty liability. They'll only pay the duty on goods that remain in the UK. Inward processing, so if you've got a company who actually is involved in the manufacturing process, they can import the raw components into the UK without paying any duty and VAT. If they sell the finished product out of the UK, that discharges the liability for the duty. So there are a lot of
both
benefits
really
to those.
Important.
Yeah.
And I think that IP, inward processing, a big issue in the manufacturing sector and certainly in the automotive sector where things move around. And customs warehousing, I mean, both of these, they're European-wide initiatives, or European procedures. So if we ship into the UK from the Far East and then we ship to Europe, a customs warehouse will stop that double dip duty.
Yeah.
And likewise, you could have a customs warehouse in the Netherlands and use that for your UK and European market.
Yeah, it's just if you've got a central trading hub and you want to ship it out, but you don't know where they're going to, you can put it into the customs warehouse without paying any duty and VAT, and then you can distribute them and then account for the duties on where they're going to. So it
might be helpful in Northern Ireland then.
Potentially, yeah, depending on what the goods are, where they're manufacturing them, and everything else. So yeah, it's not an easy thing to get, but it is certainly potentially beneficial for companies with high turnover, loads of stock, and high duty rates.
Thanks, Andrew. Would you want to maybe just explain as well about authorised economic operator and the other types of procedures that are around, just to give a flavour?
Yeah, so AEO authorised economic operator, there's two parts to it. One relates to customs simplifications. That allows companies to apply for things like customs warehousing and process a lot easier, but it's very documentary process driven, but it relates to customs compliance. The AEOS side of things relates to safety and security, so there might be certain businesses that require their premises or supply chain to be secure. It might be something that their customer or supplier asks of them, but that is also there. At the moment it's an EU-wide approval type, but obviously when we leave the EU, the UK will have their own. It will follow the same remit as the EU one at the moment, so it's not going to change the process at all. But it is there are certain benefits to it, possibly easier movement of goods across borders and things like that in the future once we settle down. And obviously looking at CFSP, so Customs Freight Simplified Procedures. If companies suddenly the impact of Brexit means that they have to make a large number of import or export declarations, there is the ability to be approved for CFSP so they can do their own customs declarations. It delays the requirement to make a declaration up until the 4th day of the following month. So a lot of customs warehouses have this already because they might import one bulk consignment and remove little bits. So if companies find that they're going to have to be making 2,000-3,000 import declarations a year, it's certainly something that they might find beneficial, because they're not having to pay the freight agent every time they get a customs entry, which is obviously an extra cost.
I mean, that's something that we will pick up on with some of the questions, but it soon adds up, doesn't it? The cost of, say somebody's got 2,000 declarations to make, how much would that likely cost them if they, for the admin of getting a customs agent to do that?
Potentially £50,000. You're looking at a fair amount of money to just for customs declarations. It soon adds up at sort of £35-45 per entry. Yeah.
We'll come on to that again in a minute with funding. And approved export is an important point, because remember that everything that we as UK businesses, and every goods that we sell to Europe, they're going to be exports from the UK. And we kind of think from a VAT point of view, it's all right, it's zero rated, I've got evidence, it's moved, but there's paperwork to do there as well, isn't there?
Yeah, so obviously with if we get a deal with the EU, then origin becomes very important, because UK produced goods could enter the EU market at 0% duty. At the moment, it's third country, no agreement, so it'd be the full duty rate. So if we do get one, then approved exporter status may be very beneficial to companies who ship a lot of UK origin goods out into the EU market, because it avoids them having to apply for a preference certificate, which obviously is a cost. It makes the whole process a lot simpler. So that's something that is worth considering, depending on what happens.
That's great, thank you. And we talked there about the costs. I mean, customs duty, the real issue with customs duty is that it's a bottom line cost to a business, isn't it?
Yep.
It's not like VAT that can be recovered. It's an outright cost to your business. And that's why the Incoterms are so vitally important, to understand who's responsible for funding that duty. Now, HMRC they've got some really good grant funding out there, haven't they, to be able to deal with training. We're an approved trainer for that, to get people to be ready and understanding it. And there's couple of other areas of their funding, which I think will be important for people who are they've got high volumes of entries, they need to do their own entries. So.
Yeah, because obviously the grant funding covers 3 aspects. There's training, which is for either new staff or staff that they are going to need to be able to be involved in either making customs declarations or involved in the customs process. Then you've got the grant for software. So if a company wants to apply for CFSP and requires extra software to be able to manage their customs processes, then there's a grant for that. And then there's the recruitment. So if companies need to recruit new staff to be able to cope with the demands that Brexit involves, then there's a recruitment grant of up to £15,000 per person. So all the information is available, and that's we can provide all of that.
Yeah, I think that's a really helpful thing for businesses. Just moving on to our last 2 points before we move on to move over to the Netherlands. Easy wins for everybody to make sure, and you've probably all got this, but if you haven't, get your EORI number, your UK EORI number. It's easy to get. Need any help, just give us a shout. Also consider whether a duty deferment account will be needed, and will help you. Although with postponed import VAT accounting, then the values that will be going through as imports may not be as high as previously thought. And obviously get an agent. There's likely to be quite a shortage in customs agents. If one's not available, you can use people pretty much like Andrew as an intermediary who can interface with that agent. So whatever happens, even if you use the deferred 6 months delay, you're still going to need an agent further down the line, or obviously do it yourself in-house.
Yeah.
Before we move on to the trading in the EU, so we've talked all about customs duty and understanding that we're going to be charged duty, we're going to have declarations, we've got all these procedures. But what about all those businesses who are selling into Europe? You know, they're still trading in Europe, they want to continue trading in Europe. And you may be sitting there thinking, well, crikey, how do I do that? Where do I begin? And certainly things to look out for, the two things I would say are, as a non-EU country, fiscal representation becomes a big issue. And in most countries, probably only about 4 that don't require us to, the UK businesses will be legally required to get a fiscal rep, and Marisa will tell us a little bit about this in a minute. And also, by doing the DDP, being that importer, you may have a VAT registration requirement in Europe. And well, let's go over to Marisa, and she can start to talk us through that.
Thank you very much, Alison, for this nice introduction. Yes, until January 1st, 2021, nothing is going to change. So I would like to pull up a quick poll to ask you how good you are prepared. Could you please help us and fill this in? I'm looking forward to your input. This is going very well. Well, thank you all very much. I stopped the poll and I can see the question was, what is the status of the current Brexit preparations in your country? Well, the result is, I see a lack of options in the poll. There will be more polls for other questions. The winner is, we haven't done anything yet. And that's, of course, a bit of an issue. Until January 1st, 2021, nothing is going to change from a VAT and customs perspective. But if we have a hard Brexit on the 1st of January 2021, everything is going to change. Which means that all supplies of goods coming from the UK into the EU or from the EU into the UK will be considered as an export and an import transaction. So you must actually involve the customs authorities. You are required to do so. But then the question comes up, which company is responsible for the import declaration? Let's focus on goods moving into the EU and then the Netherlands for today. If goods are coming from the UK and are delivered by a UK supplier to a Dutch company, if the Dutch company is taking care of the import, everything will be settled quite easily. The Dutch company will apply for an import VAT deferment license. The Dutch company has an EORI number. They can declare the import quite easily. However, if the UK company is responsible for the actual customs clearance of the goods, the UK company will have a VAT reporting obligation in the Netherlands. It must report the import, and also it will pay import duties and import VAT. As Andrew and Alison already mentioned, import duties are always a cost, so you must take these into consideration in your pricing. Import VAT is always reclaimable. And if you are planning to import a lot of goods into the Netherlands in the future, it might be worthwhile to also apply for an import VAT deferment license. As a UK company, you will not be obliged to appoint a fiscal representative in the Netherlands after January 1st, 2021. However, if you would like to use the facility of an import VAT deferment license, you must. You must appoint a fiscal rep. That's no problem at all, but you must appoint one in order to apply for the import VAT deferment license. Of course, your VAT registration must be arranged. Your fiscal rep must be arranged. One other thing that must be arranged is the EORI number. If you don't have an EORI number in the EU, you will not be able to import goods into the EU. So your UK EORI number can no longer be used after the 1st of January 2021. The Dutch customs authorities are already providing EORI numbers to UK companies as we speak. These EORI numbers are not active yet, but as of January 1st, 2021, these will become active and you can use them for your communications with the customs authorities. After January 1st, 2021, you must of course be aware that your VAT reporting obligations, which you are currently have, will change. So they do not longer will be the same as they are right now. one of the questions that we get like on a weekly basis is, do I need a separate legal entity in order to fulfill my VAT and customs obligations in the future? And the answer to that is no. From a VAT and customs perspective, it's not required. My colleague Chris Daines will speak about it from other tax purposes later on. It could be desirable for other options, of course. Well, that was the B2B trade of the goods, but what about B2C? What if you have an online shop? What if you are selling goods to consumers? You must consider all these changes as well, because goods will still be moving from the UK into the EU. You will have an export and an import. But if you have that import in the EU, who will pay the import VAT and who will pay the import duties? Will that be you as the online shop, or will that be the consumer who is buying your goods? Because if it will be the consumer, you must make sure that the consumer is aware of it. Consumers in the EU are used to a price including VAT and including duties. They are not used to pay any import VAT or import duties afterwards if they are not made aware of it. So you must make sure that your pricing is in order. Who is going to pay those, you or the consumer? And of course, is this clear from your website or not? Currently in the EU, we have a special regulation in place for distance selling. So if you are selling goods to consumers and you breach a certain threshold, VAT must be paid in all the EU countries where the threshold is breached. Currently, you must register and file local VAT returns. However, as of July 1st, 2021, that regulation is going to change, and a lot of things will become a lot more easier. So we will have one registration in one country where all the VAT due in all the EU countries can be paid. That system, of course, doesn't work for goods that are coming from the UK into the EU. So if you have an online shop in the UK, it might be worthwhile to reconsider your distribution hub location. If you have a lot of EU customers, it might be worthwhile to move your distribution hub into the EU and sell to your consumers and make use of this new simplified regulation. Next slide, please. Yes, a lot is going to change from a VAT and customs perspective in case of consequences. So the consequences of the supplies of goods will change. You must import, you must export, etc., etc. However, currently we have a lot of simplification rules in place in the EU, so also in the UK. These will change as well as of January 1st, 2021. If you are dealing with the UK in triangular transactions as of that date, you must make sure that an export or an import is declared somewhere. The current rules, for example, for simplified triangulation are no longer applicable. Then we also have a rule in place which is in line for an EU since January 1st, 2020, which is the call-off stock. You put stock at a customer's place. As soon as the customer needs it, he will pick out the stock and use it, and you will issue an invoice. Simplification regulation is in place in order to streamline the VAT consequences. However, if you have call-off stock in the UK, it will change as of January 1st because you do no longer have a transfer of own goods. You will have an export and an import. So call-off stock regulation no longer applicable for the UK. It's the same for simplified regulation for the installation of goods, and also, as we just discussed, for the distance selling to consumers. Then let's talk about another rule that is going to change as well. And we haven't talked about services yet. But if you are a company providing digital services and you are providing those services to consumers, think of selling online games, online books, apps, online media. These services are subject to VAT, so taxable for VAT, in the country of the consumer. So you must charge local VAT. In the EU, currently, a system is in place which is called MOS, Mini One-Stop Shop. Through that system, you report and pay the VAT due to the local tax authorities via one return in one country. That system will no longer be available in the UK after January 1st, 2021. So if you are a service provider who provides these digital services, you must register in one of the EU countries for MOS. Make sure that you arrange this on time, because if you're not on time, that could lead to local VAT registrations in all the countries where your consumers are established. Let's see what other regulation will also disappear. We have the VAT refund reclaimed. Currently, if VAT is charged to you as a company and you don't have a VAT reporting obligation in a country, you can reclaim that VAT through a special VAT refund request. Of course, that's an EU legislation, that's EU rules. As the UK is going to leave the EU, possibly with a hard Brexit, it will no longer be possible to reclaim VAT through that system. All VAT charged to you on costs before January 1st, 2021 can still be reclaimed through this system. So UK VAT or EU VAT for UK companies. Those refund requests must be filed ultimately before 11 p.m. on March 31st, 2021. So make sure that if any foreign VAT is charged to you, you are going to reclaim these costs on time. Any VAT charged to you on costs after or on January 1st, 2021 will no longer be reclaimable through this EU VAT refund system. So UK businesses must check the procedure per EU country, and EU businesses must check the procedure for the UK specifically. How can they reclaim the VAT in the future? So what is it that you must start doing? We just saw in the poll that not everybody already started with the Brexit preparations. But the first thing that we would recommend you to do is analyze your supply chain. How does your supply chain look? Where can I simplify things? Who will become responsible for the import? I as the supplier or my customer? And also, of course, check your pricing. Because if you need to pay import duties, it might be worthwhile to reconsider and renegotiate your pricing. Also, contact your customs and logistics partners. Check whether they are ready. Check whether they can make sure that your customs declarations are filed timely. Also check with your logistics partners whether they are ready for any transport during the Brexit time, during the January 1st, before and after. And of course, check all the contracts closed with the parties relevant for your supply chain. So not only with your suppliers and your customers, but also with the suppliers of your supplier. Are they ready? What are they going to do in case of delays, etc., etc.? And arrange all your formalities. So as Alison already mentioned, arrange an EORI number because you will need one when you start importing into the EU. Arrange a VAT registration because you will need one when you import. Arrange a fiscal representative because you will need one in many occasions. Make sure that you already start arranging these formalities as you will need them. And January 1st, 2021 will be very fast. Alison, back to you.
Thanks so much, Marisa. It's really comforting for everybody knowing that you're there to help them. And as I said, we work with you an awful lot. And I think that everybody will be able to see from all of those different complexities, we're not dealing with, let's just get the goods into Europe. We're dealing with all sorts of other issues around services, and people who do supply and install in Europe may now need to register for VAT, even though they're providing what they would term as services. And as Marisa very rightly said, it's going to come around very quickly. There's going to be a rush to get all of these things happening. So please do start talking to us about it now. And then one of the questions that we get asked an awful lot, as Marisa mentioned, is about subsidiaries, permanent establishments. Do I need one? And hopefully we've shown you that in most cases you don't. Some cases, if you're dealing with regulated goods, you may have food packaging and food labelling, CE marks, that might send you down that route anyway. But let's get Chris's view on that big strategic decision around permanent establishments.
Thank you, Alison. So far we've been talking about transactions. The VAT and customs considerations all revolve around the supply chain and when you're moving goods or potentially services cross-border, which can lead to needing a local VAT registration, as Ms. Marisa was talking about, or needing a local branch, also known as a permanent establishment with some nuances, or needing to set up a subsidiary company in an overseas territory. The transactional needs post-Brexit might mean that you need to set something up overseas, But equally, it's also a good time to stand back and say, what does our business need in the short, medium and long term? And what would work for us in relation to our tax strategy and our structure, so that we are future-proof in a very fast moving world. So there's both things to think about. What do you need to do, and what should you be doing regarding expanding the business in the current climate? There's lots of reasons to expand overseas. Generally chasing growth is one of the key aspects. Preserving current business in one way, shape or form is also a key thought. Access to talent is an area where Richard will talk later regarding the individuals. But at the moment, or pre-Brexit, most EU businesses effectively had access to 440 inhabitants across the EU. UK businesses post-Brexit, that obviously will come down to about 68 million people, and the workforce is about half of that. So that's a key consideration regarding access to talent. Having more international presence is another good reason to expand overseas. Brand recognition, setting up a service centre. A lot of businesses also talk to us about restructuring their business from a situation where they're using third-party distributors and feel they're giving away margin, and would like to both expand to enhance their global presence and protect that margin for their business at the same time. Lots of good reasons to expand, as well as the necessity flowing from the transaction. To get an understanding of the audience, I'd just like to run a quick poll question now that has 4 high-level answers. So please select the question that applies, the answer that applies most to your business. So the question is, which of the following best describes your business? We have option 1, we have many companies and branches across Europe. Answer 2, we have a small number of companies or branches across Europe. Answer 3, we're considering expanding to another country in Europe. Or option 4, we are largely a national business. Thank you everyone for popping your answers in. And we'll tailor the next stage accordingly. But if you feel there's anything you'd like us to cover we haven't had time for today, please don't hesitate to drop us some feedback and such like. Okay, so we have a marginal win of currently a national business. Very interesting. But there is also a very high percentage of people who already have a small number of subsidiaries, and 10% considering existing expansion. Okay, so I think the way forward for most businesses now, their focus moves from COVID back to the dreaded B word, is analyze those transactions. Speak to Alison, speak to Andrew, speak to Marisa. Make sure that you've got the robust structure to make sure transactionally your business continues to flow, continues to operate efficiently. And then question 2, the structure. What's our strategy moving forward and such like? So when you've decided you need to have a greater presence, greater footprint in another country, for example, Netherlands, it's important to, so just back one slide, please. It's important to realize there's 3 key options. There's your existing entity having an overseas VAT registration. Some businesses come to us and say, our client needs us to have a local VAT registration. I need to set up a subsidiary in that country. Not the case. I'd like to bust that myth. Step 2 of presence is that local branch or permanent establishment, which is effectively a silo, a division of your existing company in that overseas territory. You do not silo the risk within that overseas entity. It's effectively a part of your business that has greater presence locally and greater compliance requirements. And then there's the option 3, the full local subsidiary. A lot of companies jump to the local subsidiary route. Not saying that's the wrong answer, but I think it's always key to assess all 3 options, so which is best for our business in the short, medium and long term. As part of MHA McIntyre Hudson, we're delighted and lucky to be part of the Baker Tilly family across the globe, which is in 146 countries, I think it is, at last count. And we have these going global guides for all the major economies. So if you're thinking of expanding your business to another country, would like to understand a bit about local branch versus local subsidiary, don't hesitate to get in contact. Very happy to share these guides with you and talk you through the key pros, cons, cost benefit analysis, and what some tailored advice for you. If we can just jump onto the next slide, that would be great. So we've now sort of thought about the structure that we need in that overseas country if we are expanding. And if we do that, and if we go down the subsidiary company route, there are two key things to think about. Ensure that you have sufficient substance in that country. These kind of brass plate companies without any substance behind them are almost a thing of the past. And then we need to ensure that there is the effective management and control and such like in that country. Two key things to think about. Haven't got time to go into much more detail on those now, but happy to talk through any, on a one-to-one basis further matters on that front later. If you're already in an EU country, there's three key things to be thinking about. Restructuring. Is our business structure sufficient for the future? Do we need to rationalize the business in any way, shape or form? Merging entities and such like, and repatriation. Repatriation is really, really key. We're very lucky within the EU that there tends to only be a single layer of tax, of corporate tax, I should say, when you're trading. So if you have a UK company with an EU subsidiary, you make profits in the EU subsidiary, you pay tax, you pay a dividend up to the UK, no additional tax, and usually no additional tax at the UK level, assuming certain criteria are met. So within the group, relatively efficient. But one thing to be thinking about is repatriating dividends back to the UK prior to the end of the year, because dividend withholding taxes on the payment of that dividend from EU subsidiary to the UK can become a new tax in the chain that's unexpected. And if it's a no-deal Brexit, we'll need to very closely watch those rules to make sure no companies are caught out and pay unnecessary taxes, etc. Okay. Two other the key considerations that are very relevant for particularly companies with branches and overseas subsidiaries is historically most EU countries allow you to just have an EU or an EEA resident director. Once the UK fully leaves the EU, once Brexit finally happens, a UK resident individual wouldn't qualify potentially for that, for fulfilling that role. So a lot of businesses that are already in a number of countries will need to be thinking about how we plan and what is our contingency plan if there is no new rule that maintains that situation. We hope that rule will be expanded to be EU or EEA or UK resident director, but we don't know as at today. Okay. The second one, which is particularly relevant during COVID times, is be really careful about accidentally creating a branch overseas. Employing an individual in another country might be exactly what the business needs, but you can inadvertently create a branch that way. If you're going overseas, meeting clients and concluding contracts overseas, again, can have adverse tax consequences. And the one that's been most relevant and is very applicable to certain EU countries, but not all, is during COVID, when a lot of staff have been working at home for long periods. If that staff member has chosen to work from home in an overseas location, that could be creating tax implications for your business without you even being aware of it. And countries like Denmark have a situation where working from home can create a branch or permanent establishment, have tax implications for your business. So it's something to very, very closely think about. Okay, so in relation to the structuring aspects of Brexit, we're suggesting a kind of a fourfold approach, or the 4 I's, as we've termed it. Please do initiate a detailed conversation with your main EU tax advisor to agree a coordinated, efficient approach to Brexit challenges. So you're identifying and exploring opportunities and ahead of the curve in relation to potential risks. You've got to step 2, identify all those risks and opportunities, and you've got to immediately agree a plan to mitigate those risks and explore opportunities. We do not have enough time. December is going to be here before we know it. Life is moving very fast in this day and age. And then step 4, implement the right solution. An advisor that understands your business to ensure short, medium, and long-term success. And my final thought from me, before I hand to Richard to really get into more detail on the people aspects of the business and the talent aspects of the business, is the key to surviving and thriving through challenges such as Brexit is thinking about talent, the appropriate structure. Transfer pricing is very, very key. Once you have a number of of companies within your group in different locations, how do you price goods and services between those entities? Absolutely vital and a real focus area for tax authorities across the globe, as it's seen a way to tax multinationals, increase the tax take and such, like withholding taxes I touched on in relation to dividends, but there's other withholding taxes that could start to apply post-Brexit. And then what is the real impact going to be on your supply chain? Okay, that's enough from me. I'd like to hand now to Richard to talk about the talent.
Many thanks, Chris, and good afternoon, everyone. I'd like to kick off with a quick poll of my own. So if we could launch that, please, just to take the temperature of how everyone is viewing their workforce. Basically, what is the mix of people that you have across the UK and EU that's going to drive the people challenges that come out of Brexit? Thank you, everyone, for those responses. Really helpful. Yes, sort of an interesting split there between a mix of UK and EU local employees, a strong proportion as well, having mainly UK employees, but also having people who travel to the EU for business. And I think those responses very much drive the different challenges coming out of Brexit. And the first challenge that I put up on screen, do you understand the current position of your workforce? So if you do already have employees in the in the EU, are they because they're local hires, or do they travel cross-border from the UK? When they do travel, are they on assignment or secondment from the UK? Or do you have people traveling more sort of short-term business journeys? So it's really important to consider how Brexit is going to impact all of those different populations. And by impact, I mean things like work visas, booking travel arrangements, of course, and any reciprocal tax agreements that exist between the UK and the EU, or maybe even the different EU countries that you have that presence in. This second challenge, very much front and centre with what Chris was saying about the structure that's right for your EU operations. So when it comes to hiring in the EU to support those operations, there are highly likely to be different local employment rules, depending on whether you go with a branch, an office, or a subsidiary. And it's important to consider not just employment tax, but also, of course, the employment law rights that individuals will have in those different countries, potentially. One of the factors, certainly to think about, is whether a mix of local employees and self-employed contractors would actually allow you to access the skills that you need without having to commit permanent employee costs from the outset. So think about that workforce mix, even if it is where there's more of an ongoing permanent EU presence in future. Does that mean that you need to access, again, the local jobs market, or could self-employed people give you those skills that you need? That, of course, is, it's in the front of many UK employers' minds, given the IR35 changes. So it's important to think about whether any local rules and regulations would also impact you. Your people travelling between the UK and EU, of course, is important. So those travelling cross-border, again, think about those that have those roles and how they're going to be affected by Brexit. What will change for them? It might be, of course, that if you're going to have more of a permanent EU presence, you need fewer short-term business travellers because you're taking on more local hires in the EU. But then the flip side of that might be that actually you have an increase in the short term, maybe of UK people going on assignment to the EU in order to help set up those operations and to train the local hires. So you could see, again, there's going to be a real sort of range of responses and a range of actions that you need to take in terms of your people. And challenge 4 around talent management, something which Chris mentioned. And that's, of course, really important. That's important, wherever your talent is. But if you, as a result of Brexit, have talent more in the UK, how do you manage employee performance effectively when you've got UK and EU populations to think about? What new HR structures might you need to put in place across those different jurisdictions in order to get the best out of your people? Will you need new or different reporting lines? And how, again, will you manage effective performance? How will you know that you're getting the best out of your people? Incentivization, that's certainly important as well. So if you offer share incentives or other forms of equity reward, is it going to be possible or even appropriate to extend those incentives to workers in the EU? And again, you'd want to use those incentives to drive performance, to incentivize people to get the best out of them, given potentially the new lines of reporting and new structures that you have. Marisa was talking about, think about your supply chains. Well, this is thinking about your labour supply chain. Where are the people going to be coming from? How are you going to get the best out of them? And how can you make, Brexit a success really for your business? The final challenge I've put up there is around remote working. Now, that isn't just a Brexit challenge because, of course, we've all been experiencing remote working for many months now in the UK. And it might be as a result of the COVID sort of remote working change that you've got employees working not just from the UK, but actually some of your people might have been working from overseas. It may be that they've told you about that. It may be that they haven't. They may just have decided, to log into their laptops from a holiday or even from a more permanent move abroad. So it's important to think about whether their presence in those countries could inadvertently create a permanent establishment for you, but that will very much depend on the nature of their duties. And it's really a big part of the debate around the future of the workplace as to where you're going to need physical locations versus remote working. So not just a Brexit challenge, but one certainly that's going to continue as the changes driven by COVID become more solidified as we all get back to work. So 5 key Brexit people challenges there. I'm sure there'll be others that you will be facing, but hopefully that just sums up some of the key ones. And obviously there's further questions that we can take on those as we complete the presentation. So thank you very much. And Alison, back to you.
Thanks, Richard. Thanks, Chris. So there you have it, everybody. The Brexit challenge. There are cost considerations. There's funding that's available from the government to help. Like all challenges, it can all be overcome. You've seen how we can continue to trade and continue to thrive. And as you said, make Brexit a success. So it's all there to be done, but to be done quickly, as I'm sure we've all got today. We do have some questions, which I will come to in a second. I think we just want to run one final poll. Unfortunately, Andrew and I got so carried away with customs duty, we forgot ours, but we'll skip that for now, and let's do the final poll, Sarah. Okay, so the questions are, as I guess we want to help support you, which of the following would you like to hear more about? If you wouldn't mind answering, please. Customs duty, the global tax guides that Chris spoke about, supply chain and transfer pricing, certainly related around COVID as well, restructuring, repatriation and or rationalisation, global research and development planning, talent management, the Netherlands as an EU hub, and registering for VAT in the EU. Or all of them. You're welcome to all of it, obviously. Thanks very much. Thank you for that. And we'll be sure to make sure that anything that you would like from us, we will support you with that. So let's just run through a few questions. One question, well, a few questions actually. People are set up, Andrew, they've got their EORI number, they've got a customs agent, they've got a deferment account. Given that cost consideration of customs agent and a charge for each declaration, how can they do the customs declarations themselves, and what do they need to start thinking about?
Well, they can apply to become approved for CFSP, so Customs Trade Simplified Procedures. That gives the company the ability to make declarations themselves rather than use a freight agent. Again, that you can have the training grant and everything that goes towards that to help you get set up, and it allows, like I say, allows the company to make those import or export declarations rather than use an agent to do that on their behalf. So if you're making a significant number of declarations from day one, then it might be something that is worth considering, because, like you say, the cost impact of £35 per declaration soon adds up.
Do businesses need to get some software to be able to operate CFSP?
Yes, there are a number of software providers that you can see through the Gov website that are approved by HMRC. Obviously, don't recommend anybody in particular, but they are approved and have the relevant access into the current customs system. So it's worth looking at those to see what may be applicable, because certain companies focus on certain areas of customs rather than just general imports.
Okay, so thank you. So the answer there is that yes, you can do customs declarations yourself. You'll need some software, you'll need some training, but the cost considerations may make it a well worth investment. Okay, another question that is again around duty is, if somebody has some subsidiaries in Europe and the goods are imported, say, from outside Europe into those European subsidiaries first of all, and then move to the UK, will that company suffer a double duty charge?
Unfortunately, yes, they will do. Yeah, they'll pay the customs duty and import VAT into the EU, and then if they move those goods on, it's a third country export out of the EU and then an import into the UK. So they will incur duty and VAT on the importation into the UK. So that's where customs warehousing comes in. If you're involved in a process, inward processing, getting approval within the EU, so you can ship the goods in and move them on without incurring any customs duty. So there are ways and means to minimise the double duty hit, but it's being prepared and knowing what your supply chain is. So
yeah, back to that supply chain analysis that Marisa was talking about. A question here around, I suppose, services, because the main focus is on goods here, but we have from Pierre actually. So manufacture of machines. The machines are leased to businesses in France and Spain. Now, the London-based company can no longer passport its license to offer new leases in France and Spain, and I know we have a subsidiary in the Netherlands to deal with that. But what about contracts that are already entered into and will continue? Can they continue? In our view, yes, they can continue. You have a supply of services here, letting of machinery on hire, and because it's to a business person, then that business will self-account for the VAT in their country of destination. And with services, that's pretty much for services. Everywhere where it's business to business, we should see things being able to continue as it already is for VAT purposes. But as Marisa pointed out, with business to consumer, and the rules are already there, they're going to become stricter, but it's the business to consumer service providers that will really need to look at the implications for dealing with VAT complexities in Europe. We have one more here. How will submitting EC sales lists be done after Brexit, as I believe we'll no longer have to submit them? That's absolutely correct, you won't, but the downside is Intrastat, the dreaded Intrastat, will still need to be completed. No more here. Shall we have a look at just a couple on the chat? We've got about 19 questions on there. We'll just pick up one or two, and then, because we're conscious of time. Oh, could you please remove the right mouse menu? Yeah, sorry about that.
We'll do that.
Oh, unfortunately, we can't really see them. I'm ever so sorry. We will make sure that we get back to all of you. Oh, sorry about this, everybody. There was a question there, Marisa, you might be able to answer this, because you talked about the VAT refund claims and you talked about 11 p.m. and somebody's asked, is that UK time or EU time?
UK.
Thank you very much. Any others down there? I think what we'll do is we will come back to you on those. We will be finishing now. We've got the polls. We'll send you out information. For everybody who's asked a question, we will come back to you. We would just like to really thank you for joining us today, and thank you in particular to all the wonderful speakers and esteemed colleagues who've joined and contributed today. It's been a real pleasure. Thank you very much, and please be sure to contact any of us if you have any questions. Thank you.